Hi, this is part 2 of chapter 19. We're going to start today's lecture off with the discussion of exchange rate risk. So exchange rate risk is when you're a company that's dealing with two different currencies and the currencies fluctuate. So a foreign exchange rate is the rate at which your currency can be expressed in a foreign currency. So for example, here we have 1 US dollar is worth 98 yen, and 1 yen is worth 1 cent US. Now, a floating relationship is when two currencies are free to float, the value floats against each other. So supply and demand are going to determine the value of these currencies. Now, a fixed or semi-fixed relationship, like I described earlier, between the Danish krone and the euro, they fix one currency to the other. So let's say that, they'll say 7 krones will equal 1 euro. So they'll peg it. And that's going to be a relationship they're going to maintain between the two different currencies. Now, which makes it easy. So if you have this pegged relationship, then it makes it easier for businesses. Don't have to worry about currency fluctuations. The one problem, though, sometimes when you peg this relationship, it gets difficult to maintain the market if it gets unbalanced in any way, where there's too much supply or too much potential demand. Now, the spot rate is the rate between the two currencies for any particular day, any particular spot rate is like the right now rate, and the forward rate is the rate of exchange between the two currencies at some time in the future date. So if you wanted a quote on a currency, you could get a quote quoted in the spot rate, which is the current rate. But there's also a forward rate where the expected future value of the currency is the actual forward exchange rate. And that's established by markets because people can buy and sell the forward rate as well as the current rate. Here's some exchange rates as of 2013, and you could see it's just the US dollar on Tuesday compared to Monday, and how it changed in relationship to a multitude of different currencies. You notice that the Japanese yen is quoted in the spot market as well as the 1 month, 3 month, and 6 month forward. Not all currencies have forward rates, but generally the larger, bigger currencies will have forward rates. And this would be, again, so this is basically the Asian Pacific market, the European market, and you'll see here's the Danish Denmark krone versus the euro, the Russian ruble, and the Middle Eastern currencies. And we'll have the year to date and the per in US dollars. So here's one. If you look at the Egyptian pounds, you take 7 Egyptian pounds to equal $1. So $1 is basically 14 cents equals 1 Egyptian pound, and 7 Egyptian pounds equal $1. And today, if you look at today's rate, you'll see that it's more like 18-20 Egyptian dollars to equal 1 pound. So in a 7 to 10 year time period, you can get really big fluctuations if the currencies, if the country the currency is located in is having economic or political turmoil. Okay. All right, I'm going to skip this personal example. The exchange rate risk. So there are several economic and political factors that, of course, going to influence foreign exchange rate movements. The most important explanation for long-term changes in exchange rate among different nations is the inflation rate between the two countries, because a higher inflation rate is going to equal more risk, and that's going to have to be reflected in the foreign country's currency. So high inflation rates will see the currencies decline in value relative to currencies with lower inflation rates. So like we were talking about before, Egypt, and let's also throw in Venezuela in there, they have higher inflation rates, and that's been effectively devaluing their currency against the euro and the dollar, which have lower inflation rates. So those currencies are more risky. So naturally, people would want to take their money out of those currencies and put them in a less risky currency, and that supply and demand imbalance is what can create the the devaluing of a foreign currency. So let's assume the currency exchange rate between the United States and a new nation, we'll call it Farland, is 2. So two Farland currencies, we'll call them FG, per dollar. So it'll take two of their currencies to equal $1. Or $1 would equal, one of their currencies, one FG currency would equal 50 cents, and a dollar would equal two FAR FG currencies. So if I had $10, I can translate that into 20 FG currencies, and if I had 10 FG currencies, that would only translate into $5. Okay, so the exchange rate means that a basket of goods worth $100 in the United States. So if we took the $100 times the FG, which is $1 equals 2 FG, the FG would be 200 in Farland, and vice versa. So that's basically the example I made before. Now assume that inflation is running at 25% annual in Farland. The annual rate is 25%. But it's only 2% in the United States. So in 1 year, the same baskets of goods in the United States, in Farland, that basket of goods is going to increase by 25%. So it goes from 200 FGs to 250 FGs. But in the United States, it only goes to 102. So this relative prices imply that in 1 year, 250 will be worth $102. So the exchange rate in 1 year should be similar to that effect to have that inflation affected. So it would be 250 divided by 102, or the new exchange rate would be 245 per US dollar, or 0.41 US dollars equal 1 FG. And because it's supposed to, inflation has an influence on the value of the currency. So the Farland currency will depreciate from 2 to 245. And we call it the depreciation because it used to take 2 FGs to equal $1, but now it takes $2.45 FGs to equal $1, and that's a depreciation. While the dollar appreciates, where it used to just be you only needed 50 cents to get 1 FG, now you need only 41 cents to equal 1 FG. So this is an example of how exchange rates can change with inflation. So the financial statement of a foreign company, we would look at, we would translate the balance sheet, so we could have assets in British pounds, and then we could have US dollars, and then combined. So we have the foreign exchange rate assumed from the US dollar to the pound, and the foreign exchange rate assumed it from A to B. So this is A and translated to B between 2015 and 2016. So we would have to, this currency stays stable, but we have a different rate in 2015 compared to 2016, which changes the overall value of the balance sheet in dollars. So accounting exposure is a risk resulting from effects of changes of foreign currency rates on the translated value of the firm's financial assets. Accounts denominated in any foreign currency, of course. So the economic exposure is a risk resulting from, having money in foreign currencies and exchanging that back to the firm's domestic value. Now, political risk is going to be if a country, say like Venezuela, becomes more politically unstable and they might want to seize or gain control of a multinational like Venezuela had done with American oil companies, then that political risk is going to affect their currency as well. So, the host government takes over the assets and operations of a foreign firm without proper compensation. This increased political risk is going to have effect on the foreign currency. So, and you have both a micro and macro political risk depending on the subjugation of all foreign firms or the subjugation of an individual firm. Either way, this is bad news. It makes doing business in the country much, much more riskier because your assets could be taking over, and that's going to have an effect on not only the foreign country's currency value, but also on the amount of foreign direct investment the country will draw if they're going to, start taking over foreign companies. And you usually see this most often with oil companies, where a foreign company will just decide, a foreign country will just decide to nationalize the oil industry and steal all of the assets of foreign companies doing work in that area. It's a part of a risk of doing business. So if you want to cope with the political risk, you can try to do prior negotiations or prior agreements to protect for this, or what would happen in case of this. You can have an agreement where X amount of money is going to be stored in an escrow account in the United States. So if the company is taken over by the government, that company has access to that sort of escrow fund. Different things like that can be done to try to make some kind of positive approach to mitigating this risk. Now, more negative approaches: licensing or patent restrictions, control of external resources, control of transportation markets, control of downstream processing, control of external markets. This would be some political risks that would be negative to a country. Now, so there's many different. Every country has its own unique basket of political risks that a company is going to have to think about before doing business in that country. And they're going to think about the best way of deploying the business to minimize or shelter their assets from any potential political risks. Okay, so national entry control systems are comprehensive rules, regulations, and incentives introduced by a host country to regulate the flow of foreign direct investment from multinationals, because all countries would like some foreign direct investment because it helps stimulate the economy and helps employ people. In the United States receives the vast majority of foreign direct investment, with foreign companies building, manufacturing, and service-related plants and operations in the United States and to sell directly into the United States market, and often hire many United States citizens. So there are a lot of benefits from encouraging the inflow of investments. Now, national entry control systems regulate the flow and a variety of factors: local ownership, level of exportation, use of local inputs, number of local managers, international geographic location, number of local borrowing, percentage of profits remitted, and capital to be repatriated. So, for example, if you're Nissan and you're going to locate your automotive manufacturing plant in the southern part of the United States, I think it might be in Tennessee or maybe Kentucky, I'm not exactly sure, but they have a big plant there, one of the biggest in the United States. And there will be, an agreement that X amount of auto parts that are going to be used to make the manufactured vehicles have to be U.S. made auto parts. So these are, things that we have to look at. What the government laws are, percentage of the ingredients or components that have to come from American sources, and so there's all these things that you have to worry about that the host countries will try to control to help facilitate not being taken advantage of. And they also, in many cases, they can either increase or decrease political risk by making the multinational companies benefit, or if the policies benefit the multinationals, that's going to make it more attractive to foreign direct investment, such as lower tax rates or subsidies. But if they're negative, such as extra tariffs or extra regulations about how they're going to conduct businesses or wages they're going to pay, that could be discouraging. So when we look at ethics, Chiquita Banana from Latin America operated banana farms from Mexico to Ecuador. So they received a lot of threats to facilities from in Colombia from military organizations, and the U.S. Chiquita became the first U.S. corporation ever convicted of financial dealings with terrorists, as they sought to pay extortion or ransom to keep their employees and their banana plantations safe. And it's against direct U.S. law. Companies are not allowed to pay extortion to foreign governments or terrorist organizations to protect their assets. So but I guess Chiquita felt it was necessary. It was easier, more profitable to pay the extortion rather than try to defend or um, protect or close down their plantations in Colombia. So, ethically, if the reason this is not good is because if you are paying extortion to terrorist groups, it makes the terrorist groups stronger, which enable them to extort even more people. So you can see how or why the U.S. put a law up that would discourage or make it illegal for companies to do this. So there's your ethics lessons for today. Long-term investment and financial decision. So foreign direct investment often needs a long-term view for the firm to manage capital and the introduction of technical assets from its home country to its host country. So FDI, foreign direct investment, can be explained on the basis of two main approaches: the OLI diagram, or paradigm, and the strategic motives by MNCs. So the first encompasses the O, owner-specific advantages in the home market; L, location-specific characteristics; I, internationalization, through which multinational controls the value chain in the industry. So it's the OLI. And the second refers to companies that invest abroad as they seek markets, raw materials, production efficiency, knowledge, and political safety. So a lot of times the diversification of investing throughout the world helps to lower the risks of the company in general. Now, there are other factors that are unique to international settings that need to be examined when one is making a long-term investment decision, say building a second headquarters in a foreign country or second production plant. The firms have to consider the elements related to the company's investment in a subsidiary on the concept of taxes. So how are they going to deal with new tax obligations? The existence of different taxes, as we talked about earlier, can complicate the measurement of cash flows, the amount of money received from by the parent company from the international company, and the tax consequences related to it. And if the tax consequences in the United States are too great, you may want to leave your profits in the foreign country and not repatriate them. Then what do you do with all that foreign profits you've been making? And many times the U.S. companies will reinvest them in other foreign countries rather than one of the political motivations for lowering this tax rate is we want to encourage our domestic companies with large pools of foreign profits to bring that money back to the United States and reinvest here. And they will only do that if the tax rate is beneficial to them. And finally, there's an issue of risk attached to international cash flows as far as foreign exchange rates. Now, when we're talking about discount rates, and remember, discount rates are used to calculate net present value, which we learned both in this class and in the finance class before this class. That so the parent company has to add the risk premium to their discount rate when calculating the cash flows and the possibility of exchange rate changing between companies when they're looking at cashing out or developing properties in a foreign country. So long-term decisions, both theory-based and empirical evidence, suggests that capital structures of multinational companies differ from those of purely domestic firms, and several factors tend to influence the structure of these capital markets. International capital market rates, international diversification, and country factors are all going to make the capital structures of multinationals different than domestics, because multinationals will have access to a different variety of some, in many cases, lower cost capital that they can utilize when expanding their company overseas. So let's skip to the global focus and overseas assignment to take a step up the corporate ladder. So say you're working for a company and they want to send you overseas to spearhead, stay in a foreign country, get a different perspective on the world events and how their product is perceived in other markets. It's a good way to enhance your career and enhance a resume. So international experience is very sought after by many companies. So as globalization pushes companies across borders, CFOs with international experience operating companies or divisions in other countries is very valuable. And you'll see a lot of CFOs having a lot of this international experience and doing mergers and acquisitions or joint ventures with foreign subsidiaries. Okay. Now, long-term investment and financial decisions. When we talk about long-term debt, you got to think about international bonds. So a bond that's sold outside the country of borrowers is often distributed in several countries, can offer a lower interest rate. Now, a foreign bond is an international bond that is sold primarily in the country of the currency which the issue is denominated. So an international bond sold in Germany would be denominated in the euro, and it is so. But if we talk about the euro bond, this is an international bond that is sold primarily in countries other than the country of the currency which it's denominated. So a euro bond could be based on dollars. I know it's confusing. You would think a euro bond would be based on euros, but it's not the case. Euro bonds are basically based on a different currency. And the euro bond market existed before the euro did, so I think that's why some of that confusion exists today. Okay, so if you hear meowing in the background, that's my cat Barb, who's named after the show Stranger Things. It's a long story. But anyway, long-term investment and financial decisions. So if we look at long-term debt, for foreign bonds, underwriting these bonds, the handles in different countries that they're issued in have their own unique ups and downs and their own rates of interest and risks. So for euro bonds, a number of financial institutions, the United States, Western Europe, and Japan form these international underwriting syndicates that will share the underwriting costs for euro bonds and make them comparable for the bond flotations in, say, the U.S. Domestic market. So the U.S. domestic market and the Eurobond market together are, probably 90% of the world's bond market in total currency. Now, multinationals can use hedging strategies to change the structure characteristics of some of the long-term assets and liabilities. So you know what? A hedge is a way to protect yourself on an exposure. So you can swap interest rates to obtain the desired stream of interest payments. For example, you might have a fixed rate and exchange it for a floating rate. You can also do currency swaps where you can exchange assets and liabilities denominated in one currency, for example, US dollars, for another currency, British pounds. So these are ways either you're basically trading or swapping your risks to help protect you from the uncertainties of currencies or interest rates of exposure from different foreign markets. Typically, they can use the futures market to help hedge these exposures and use it as a cost savings measure, and specifically to hedge currencies as well. Okay, so as far as equity capital, this is the stock portion. When we say equity, we really mean like the owner's capital or stock equity. So it's raising equity funds for multinationals to have the parent stock distributed internationally and owned by stakeholders of different nations. So you have a company like Sony that has shareholders in the United States and shareholders in Japan, and the stock is traded on both the New York Stock Exchange and the Japanese exchanges. So you benefit enormously if you have an international stock market. If your stock is traded in multiple markets in the international stock markets, there is no one stock market that's like one world international stock market, but rather a loose association of stock markets in many different territories and countries around the world. So if there was an international stock market, that would be very beneficial, and that's something probably that is likely to occur at some point in the future. Now, in international operations, usually a domestic source of short-term financing along with other sources are available to multinational corporations, and this can include accounts payable, accruals, bank and non-bank sources, and each of the subsidiaries' local environments and the euro market. So just basically that if you're a company like Starbucks operating in many different countries, you have access to local borrowing in every country that you're operating in. and they can provide you short-term financing and banking solutions to those multinationals. Now, a nominal interest rate, this is the international, in the international context of a way of looking at it, is a stated rate of interest charged on financing when the multinational parent company is involved. Now, the effective interest rate is the international in the international context is the rate equal to the nominal rate plus or minus any foreign appreciation or um, depreciation. I'm having trouble saying that. Let's try that again. Depreciation of a foreign currency relative to the currency of the multinational's parent. So that basically is just saying that if the foreign currency is going to change, that has to be incorporated into the effective interest rate to take account of that risks. So we have, of course, a formula for this, and basically to calculate the effective rate, would be the given nominal rate for a particular rate of currency, which we'd use N as to denote that, and its foreign percentage of change, which would be N plus F plus N times F. Okay. So multinational, as an example, multinational plastics company, International Molding, has subsidiaries in Switzerland. Local currency is the Swiss franc, because Switzerland is historically neutral, so they kept their country out of the euro currency. And on the basis of each subsidiary's forecasted operations, short-term financing needs in equivalents of US dollars. So Switzerland, 80 million excess cash to be invested. In Japan, 60 million funds to be raised or borrowed. So what we would look in the spot rates, we'd have the spot rates with Swiss franc and Japanese yen, and the forecasted change, and then we could calculate the nominal euro market domestic interest rates, and then we can calculate the effective rates for each of those. So, well, they're stated, they're not calculated. So for investment purposes, the highest available effective rate of interest would be 3.3% in the US dollar euro market. So we see that right here, US dollar euro market. Okay. Now, therefore, the Swiss franc subsidiary should invest 80 million in Swiss francs in US dollars to raise funds, the cheapest source to open the Japanese subsidiary. So, So you want to raise fund because for the Japanese subsidiary. So you basically want to play the market to get the best combination of interest rates. So we have the cheapest source open to the Japanese subsidiary of 2.1%. So we want to use this 2.1%, which would be that the Swiss franc. So the subsidiary would therefore raise 60 million in Swiss francs in the euro market, and these two transactions would result in more revenue and least costs, respectively. So it's really just using that translation of currencies between the US dollar and between the Swiss franc and the Japanese yen. Now, in the international cash management, international firms can respond to exchange rate risks by protecting hedging. So hedging and protecting are the same thing. Protecting yourself from loss by hedging your positions. Now, hedging strategies and techniques are used to offset or protect against risk. And the risk is really the change in value of a currency. So in the international context, borrowing or lending in different currencies, undertaking contracts in the forward or futures market or option markets, and swapping assets liabilities with other parties to help protect yourself from these risks. So hedging rate risk, hedging different tools. So borrowing or lending. So if you know you're going to need money in one particular currency, or you're going to be paid money in another currency, you can borrow it today, so lock in the rate. So when you're paid that currency, you can pay back the loan. You could represent the obligation in a forward contract, which is a very tailor-made specific contract to buy or sell currencies at a specific rate. But that you're locked in here, and you can eliminate the downside risk, but it locks out any upside potential. And you can also do a futures contract, which will eliminate the downside risk. Plus, the position can be nullified to create some possible upside risk. So a futures contract is a contract through the futures market that's more generic, more easily tradable, where the forward contract's really not tradable. Now you have the option markets. So just like stock options, you can buy the right to buy the currency at a certain price for a certain specific period of time. So this can eliminate the downside risk and retain the unlimited upside risk. So if it goes in your favor, you could just let the option contracts expire. You pay whatever the minimal cost is for the contract, and you can enjoy, simultaneously protect yourself and leave yourself open to a potential windfall in currency profits. You can do an interest rate swap. So this is one interest rate stream, say in US dollars, could be swapped for another floating rate US dollar instrument to so you can if you want floating rates, you can swap it with so you have to have someone else to agree to exchange these obligations. And you can do this with a currency swap too. So two parties can exchange. So you say you had a European company and an American company, so the American company is going to be earning euros and the European company is going to be earning dollars. They can just agree to swap these two different currencies initially and pay each other's interest payments, and then reverse the principal amounts, the pre-agreed exchange rates at the maturity. It's more complex than an interest rate swap, but usually more cost effective. And there can be hybrids of any type of these strategies for hedging. So when you're talking about the more short-term cash management decisions, so you could use a forward contract to hedge an exchange rate risk. So assume you are a financial manager for Boeing, which has booked the sale of 3 airplanes worth $360 million to Japan, Japanese Airlines. Now the sale is dominated in Japanese yen, and the current spot exchange rate is 1 US dollar equals 108 yen. Therefore, you have priced the airplane to sell at 39 billion yen. So if deliveries were to occur today, there would be no foreign exchange risk because you would get that rate today. And the payment, however, if the payment is going to not be delivered for 90 days, this transaction is not hedged. Boeing has an exposure in case the Japanese yen depreciates over the next 3 months. So now suppose between the delivery date and the dollar appreciates against the yen from 108 to 110. So upon delivery of the airplanes, the agreed upon price of 39 billion yen would only be worth $353 million. So you're losing about $6 million based on this foreign exchange loss. So instead of remaining unhedged, you sold the 39 billion in the forward market. So you sell first, because in the financial markets, like stocks, you can short sell. So you do a short sell of the yen for a 90-day forward rate of 107.92 offered by a bank. Then you could lock in the net dollar sale price of 361 million, realizing an actual gain of 1.5 million by locking in those rates today. You can guarantee the actual money you're going to collect because it'll offset any changes when you actually do collect the money and from the profits from the foreign exchange contract. So if the actual cash position was to lose 6 million, the profits in the forward market would make up for that. So in responding to foreign exchange rate fluctuations, these multinationals can give international cash flows some protection through appropriate adjustments in assets and liabilities. So there are 2 routes available. The first centers on the operating relationships that a subsidiary from a multinational maintains with other firms or third parties, depending on the management's expectations of local currency position. Adjustments in the operations would involve the reduction of liabilities if the currency is appreciated, or the reduction of financial assets if it's depreciated. The second route focuses on the operations relationship a subsidiary has with its parent or other subsidiaries within the same multinational corporation. So in dealing with exchange rate risks, a subsidiary can rely on intra-multinational accounts. Specifically, undesirable exchange rate exposures can be corrected through the extent that the subsidiary can take the following steps. 1, the appreciation-prone countries collect intra-MNC accounts receivable as soon as possible and delay the payments of intra MNC accounts payable as long as possible. In a depreciation prone country, so the United States would usually be in appreciation, and like say Venezuela or Argentina or maybe Egypt would be a depreciation prone country, then they would want to collect the MNC accounts receivable as late as possible and then pay the transactions and the MNC accounts as soon as possible to take advantage of the appreciation or depreciation direction of the country. So it's basically just saying we want to, if the currency is depreciating, we want to delay payments. That means we're paying less. And if the currency is appreciating, we want to collect fast or pay fast to take advantage of our stronger currency. So assume that a U.S.-based parent, American Computer Corporation, buys parts from and sells parts to a Mexican-owned Tijuana computer company. So assume that ACC has accounts payable of 10 million and is scheduled to pay it to TCC in 30 days. In turn, it has accounts receivable of 115 million in Mexican pesos due from TCC within 30 days. Because of today's exchange rate, MP is worth 11. It takes 11 Mexican pesos to equal $1. The accounts receivable is also worth 10 million. So if it believes that the peso would depreciate from 11.50 to 12.75 during the next 30 days, the combined companies can profit by collecting the weak currency debt immediately and delaying the payment of the strong currency for the 30 days allowed. So if the parent and subsidiary do this, the peso depreciates as predicted. The net result is that the MP of 115 million payment from TCC to ACC is made immediately and safely converted to the 10 million at today's exchange rate, thereby avoiding any depreciation. And then in comparison, the delay of the $10 million payment from ACC to TCC, it will be worth 127 Mexican pesos as the dollar appreciates. Thus, the subsidiary will experience a foreign exchange trading profit of 12.5 million pesos. And that's how the company and subsidiary can work together to take advantage of the direction or the momentum of the currencies. And generally, currencies trade in momentum that one currency is appreciating while the other currency is depreciating, and they stay on that momentum track for longer periods of time. So it's easier to predict where these currencies are most likely going by just finding the slope of the currency's trading activity. Excuse me. So now let's talk about short-term financial decisions, credit, and inventory management. So in addition to use the hedging of various assets and liability adjustments described in the previous slides, multinationals should seek the backing of their respective governments in both identifying target markets and extending credit. So multinationals based in the number of Western European nations are those based in Japan benefit from extensive involvement of government agencies that provide them with the needed services and financial support. For U.S.-based multinational government agencies such as the Export-Import Bank do not provide comparable level of support. So in some countries, say China and Japan, the government's a little bit more involved and a little bit more supportive of their businesses as almost a subsidy, where American-based companies don't get nearly as much governmental support. So in terms of inventory management, multinationals must consider a number of factors related to both economics and political environments. So in addition to maintaining an appropriate level of inventory in various locations around the world, a multinational firm must deal with exchange rate fluctuations, tariffs, non-tariff barriers, integrated schemes such as the EU and other rules and regulations and trade pacts and policies. So politically, inventories could be subject to wars. They could be subject to foreign governments seizing them. They could be subject to blockades, other forms of government intervention. So mergers and joint ventures, the motives for domestic mergers, growth or diversifications is, you want to grow your company. So it's easier to grow as a merger because you can diversify the risks. The synergies between the two companies can help increase the sales. So, for example, when Gatorade was acquired by Pepsi, or when vitamin water was acquired by Coca-Cola, they gained the synergy of now having access to the distribution juggernauts of Pepsi and Coca-Cola to greatly increase the sales of those products. You can also get increased managerial skill or technology. For example, if a gasoline-centric automotive manufacturer purchases an electric automotive manufacturer such as Tesla, they get all the benefits of their technology. There are going to be certain tax considerations, such as when we talked about Burger King, and we talked about them merging with a Tim Horton, a Canadian company. They had better tax reasons, increased ownership liquidity, being able to diversify the owners being able to diversify their assets in the companies better. Defense against takeovers. If two big companies are merging, it makes it harder for a third company to take over this new bigger merge or joint venture company. Okay, so that brings us to the end of this rather lengthy chapter on international finance. And in this chapter, we discussed the major factors that influence financial operations of multinational companies. We talked about the major factors that influence financial operations, the differences between domestic and international financial statements and how to consolidate them, translation of individual accounts and international profits. We talked about exchange rates, risk, political risk, and how to manage them. We talked about describe foreign direct investment of cash flows and decisions, capital structure, international debt and equity instruments. We described the foreign direct investment cash flows and decisions, capital structure, international debt and equity instruments available. We talked about the euro currency market, short-term lending and investing, the basis of international cash credit inventory management. And finally, we talked about the international trends and mergers and joint ventures. Okay, so that is the end of chapter 19. Thank you, and talk to you soon.